Thanks for tuning into today's Talking Point. I'm Neeraj Shah, and it's the most opportune time to get in Mihir Vora of Max on the show today. He's our guest, and I call it the opportune time, not for the fact that Mihir, after a long time, is seen in a tie, but also because it's the week wherein we'll hear from three central banks. We are nudging 20,000, maybe a few hundred points, give or take from there. So the momentum and the euphoria is certainly out there. Mihir, great having you. Thanks for taking the time out.
Always a pleasure. Thanks for having me.
No, the pleasure is ours. Mean, what's your sense? I mean, I'll start off with the global macro. We have the Fed, BOJ, of course, some murmurs already out, and the ECB. Do you reckon rates stroke or the decision stroke commentary could be conducive for risk assets or not quite?
Neeraj, I think the growth angle has surprised everyone, especially in the US. So the kind of growth in retail consumption, especially the services sector that has happened in the US, has, I think, surprised everyone. And that's also the reason why the bond markets are saying one thing and the stock markets are saying another thing. You know, if you look at the bond markets, the yield curve is inverted at the maximum level ever, the 10-year minus 2-year yield, which means that the bond market expecting a recession for sure. But the equity markets are, almost, especially the tech stocks are back to their highs almost. So there is a dichotomy. I think as far as India is concerned, even if the Fed were to hike by 25 basis points one more time, I think it's pretty much absorbed. We've seen a sharp hike cycle for the last 15 months. In spite of that, I think the flows to India, which is what is relevant to us, have not been too bad. Of course, we saw outflows in 2022, but in the last 3-4 months, again, as India has been resilient in terms of its own growth, money has started coming back again. So FII flows have been positive. So I wouldn't be too worried about the Fed hiking one more time. Yes, there might be some sentiment impact if it is too hawkish, which it may be needed to talk hawkish given the strength as we talked about in the US economy. But I wouldn't be too worried, frankly speaking.
Got it. I saw a tweet from you, Mihir, which spoke about how because of the high levels of debt that the Western economies have, there's no choice but for the rates to move down. Now, my question is, if the US economy, as you said, is showing a lot more resilience than what earlier envisaged, could the pushback of rate cuts further away than what is envisaged currently be a dampener for flows and for sentiment? Or do you think in India's case, because the domestic flows are anyway so strong and because China is not giving that hard stimulus, India will still continue to be prim and proper?
Yeah, I think so. What you're describing is a Goldilocks situation, which we are in currently, where the US is doing okay, but not so bad also that it impacts our overall GDP, global GDP growth expectations. But it's not doing too good either, as the bond markets are saying that there'll be a recession. So it's kind of a situation where stocks are saying that even if there's a recession, and which the bond markets are saying, it will be followed by, dovishness immediately. So I think the ECB and the Fed have very thin skins. And if there is any negative adverse reaction on the growth front, they will immediately come back to their loosening cycle. And that's what the stock markets are saying.
Are you constructive, me at 20,000 with such valuations? It's difficult to give a call that, okay, I'm near-term tactical constructive, even if you're long-term constructive. So I'm just trying to bifurcate between the next 6 months versus your view over the slightly longer term.
So at 20,000, I would say, we are talking about the Nifty, which is large cap, of course. I think there are still pockets of attractive valuations. For example, while banking index is almost at its all-time highs, the valuations in terms of price to book, etc., are still not at the pre-COVID levels. So there is some pockets of value in banking. There is some pocket of value even in engineering companies, I would say, the large cap engineering companies. So the Nifty, I don't think is overvalued. Little above long-term averages, maybe 5-7% above long-term averages, which is okay. If we deliver growth, then this is justified. So as far as the large caps are concerned, I'm not too worried. I think in small and mid caps, there is a bit of froth happening. The same 200-300 stocks are being chased by PMS, local mutual funds who are getting flows. So that's where I would be a bit more cautious and more selective.
Interesting. So despite that, I mean, Just I was reading a sell side report which said that the Nifty may be at one standard deviation or slightly even more than that above mean, but a lot of pockets individually are not. They started BFSI, something that you did too, wherein the valuations are not quite there, and therefore if flows continue both local and global, then you might well see, even if the markets consolidate, a lot of those pockets start rising because that is where the flows will go. You are a large institution yourself, Mihir. When you get the monies now, is that natural way of thinking that let me try and look at now pockets, or let me now try and look at pockets which are not overly valued? How do you think about it?
So valuation is something that works all the time, that we have to take care of all the time. But more important than valuations is our estimates of growth for that particular segment. So if we are saying that the economy will continue to grow, then corporate lending, MSME lending, as well as retail lending will continue to grow. For the last 5 years, we've seen retail lending being the pillar of growth for banks as well as NBFCs, whether it's in terms of mortgages or personal loans or credit cards or durable finance, microfinance. But it's all been led by retail. Now, if the Indian economy has to grow at 7 to 8%, so even if not 6.5 to 7%, it has to come on the back of corporate growth, and that's where we think that the biggest risk is and biggest opportunity is that if corporate lending comes back, that can be the next leg of investments as well as the uptick in the market.
The commentary thus far that we saw from banks was constructive on growth, not so constructive on net interest margins. In fact, all of them have seen contraction and spoken about further contraction. Could that be a worry, or do you think growth will kind of triumph over small niggles?
I think growth is most important. Banks are too smart. The banks and NBFCs are too smart. They will not compromise on their margins if there is a demand. So I think what matters is demand.
Okay, fair call. The last again, trying to bifurcate between domestic and global, and sticking with domestic for the time being. Um, the the last few days have seen some splendid moves in power related names, Mihir. Be it generation, be it distribution, be it companies which kind of are suppliers to the power names, and the renewable side has gotten major contracts, even PSU names. I mean, I'm just trying to understand. It's a space that has long been plagued by uncertainties. Could this time be for real? How are you thinking about it?
Sure. So this is again a part of the broad government theme to kickstart investments and do structural reforms in the sectors where it's not so politically sensitive. For example, so on transmission, it's not politically sensitive. You need to have a good nationwide grid, and you can see the outlays for the PSU companies on distribution. They are investing a lot on HVDC transmission, creating grids which are resilient because now that incrementally more than 50 to 70% of the capacity addition will come from renewables. It needs a lot more sophisticated grid because for example, wind is not available all the time, solar is not available all the time. It also happens that when in the night when solar is down, actually it's windier. So you might actually have wind taking over from solar in the night time. So that requires a lot of to and fro of transmission of power from pockets of generation to the user segments. So I think strengthening the transmission and distribution grid is necessary, without which this whole renewable thrust is not going to happen. So I think it's only natural that we know that a certain amount of 10 to 15 gigawatts of renewables are going to come in every year, and that parallelly needs to be strengthened by the grid, which is what the government is focusing on. Uh, on renewables per se, the government has been very serious, not only in solar but also in wind and nuclear. And we are also talking about a lot of storage capacities being set up. A lot of hydrogen capacities have been announced by the biggies. So all this will require a lot of investment in transmission and distribution, which is what the government is gunning towards. So I think this thrust of hydrogen, solar, wind, and nuclear is something that can be a multi-year theme, and we are just beginning to see investors and the markets factoring that in.
What's the best way to invest within this pocket then, Mihir?
There's a wide range of pockets, I would say. Of course, the equipment suppliers for transmission and distribution, large tenders for smart metering, etc. So that's one way of playing it. The utilities themselves, for example, the thermal utilities are setting up are setting up solar capacities. The hydro utilities are also setting up solar as well as further more hydro capacities. So I think it's no longer a case of very specialized, power utilities. Everybody who has surplus cash generation has been encouraged and is being told by the government to set up renewables capacity, whether it's in solar or wind. Nuclear, of course, is a smaller element, but that also is something that is coming up. Not to forget, a lot more action will happen in storage, whether it's battery storage or pump hydro. And to that, hopefully the PLIs that have been, announced not only for solar panel manufacturing, but going backward all the way to the silicon substrate level, is going to make a big difference in the next 3 to 5 years.
Got it. Mir, please correct me if I'm wrong, but sorry, I'm jumping tracks and going back again to financials because I missed a key element there. Uh, were you constructive on PSU banks? And I'm just trying to understand because the street is slowly starting to converge on the optimism there, both sell side, buy side. The numbers are not looking all that bad. What is your thought?
I think as far as PSU banks are concerned, there was a valuation gap that was created. And again, like the private sector banks, even PSUs in the last 5 years or so have not really gone out and lent to the chunky corporate because, frankly, there was no demand and not many corporates have set up all these greenfield kind of mega projects. So to that extent, even for the PSU banks, the book is kind of more granular than before. Probably PSUs have a little more exposure to MSME compared to the private sector, but that's fine given their reach, etc. So I don't see a threat, at least as far as asset quality is concerned, for PSUs in the next few quarters.
Okay, fair call. Doesn't mean that you are very constructive, but at least the asset quality issue is not there.
Yes. So, but in PSU banks, we are sticking to the top 2, 3 names, frankly speaking. Within the financials, our incremental preference has been more on the NBFC side, because we are saying that in the second half of 23, RBI's peak hawkishness would have gone past us. The tightness in borrowing rates, etc., would be past us. So to that extent, the margin improvement should happen for NBFCs because the cost of borrowing will reduce. NBFCs typically tend to be wholesale borrowers. So to that extent, cost of funding can be a tailwind for NBFCs. And distribution-wise, NBFCs never have a problem of getting volume growth as long as they can get the funding.
Got it. Veer, have the earnings season thus far, or even taking off from what happened in Q4, surprised you in any fashion whatsoever, or has it largely been in line with what you estimated? And if there is a surprise, where is it that you've been really surprised?
I think some of the negative surprises have come in IT. But apart from that, the domestic segments, especially the financials, have been broadly positively surprising. I think they have managed the margin issues much better than anticipated. And in some of the cases, even volume growth has come through. So to that extent, I would say on balance, a little more positive than negative in terms of surprises.
Okay, that's not good. That's not music to the ears. Okay, a couple of questions, me on the exporting side. We were talking to Pranjul Bhandari of HSBC a few days back, who's noted that high-tech exports out of India have really picked up, even as the low-tech exports, commodity goods, etc., are struggling. Now, depending on, and you look at macro very closely, me as is evident from your Twitter timeline. So based on your assessment of what could happen to world growth over the course of the next 6 months, what is your view on the exporting elements out of India? Various sectors out there, how do you look at them?
So I think as far as, for example, I don't know whether chemicals and specialty chemicals come into low tech or high tech, but that is one theme that that can pan out in terms of volume growth quite well in the next few years. Most of our chemical companies, whether it's bulk chemicals or specialty chemicals, have been very successful in the last 5 years, and they have generated huge amount of cash flows, which they are now deploying into ramping up capacity rapidly. It's also aided by the China plus one move. After COVID, everybody wants to de-risk, and even after India doubles its capacity, China will still be 85 or 90% of those chemicals. So I don't think we have scratched the surface. There's a long runway if people really want to seriously look away from China. So I think places like chemicals is something that we can see a structural story. Uh, Electronics, which is I guess where a lot of high tech exports happen, and machinery manufacturing, for example, India has actually surprisingly done well in machinery exports, capital goods exports globally. But the electronics theme, whether it's mobile phones or even consumer durables, can be a theme going forward, because this we are just beginning to see the scale at which PLI is beginning to impact. So right now, of course, most of the companies that we see in the space are assemblers, and then going more into design and efficiencies. Some of the companies have moved away from not only consumer electronics but to medical device electronics, to defense electronics. All this, I think, is coming together, and we are gradually and not gradually, I would say rapidly achieving economies of scaling more and more sub-segments. So that, I think, is going to continue. And places like Vietnam, Thailand really cannot be an alternate to China. So again, even in electronics and white goods manufacturing, if at all anybody wants to de-risk away from China, then India is a natural choice. And with PLIs, being quite attractive and beginning to attract a lot of attention, there is a long runway in high-tech exports, I would say.
Okay, cross fingers for that. We'll wrap up this conversation with one final question. I heard you speak about the negative surprises in IT. If Infosys commentary was anything to go by, there's a lot of clouds on the horizon and right here, current and front and center. Are you very negative? Are you neutral? Or do you believe the valuations bake in the negatives?
The thing is that you need to look at it from the portfolio point of view.
Okay.
And if I'm finding better pockets of growth in other sectors, then I would be neutral or underweight or significantly underweight in segments where the growth is suboptimal. So even if the IT companies are managing to meet the guidance or even up the guidance by say 1 or 2% in the second half, we're still talking about high single digit or low double digit kind of growth for most of the IT companies, which is back to say pre-COVID levels. So the whole IT services story happened post-COVID because there was a bunching up of spending globally to enable work from home, to enable online shopping because of COVID lockdown, etc. So I think that is past us. So that bump up, or we can say, that lumpiness in spending was probably a one-time event. Of course, now there are new areas like AI coming in, but those may take a little while to ramp up. So to that extent, I think we are back to pre-COVID kind of high single digit growth rate for the segment. To that extent, if I see more value in engineering, capital goods, consumer discretionary, or sub pockets like defense, as we discussed, renewables, transmission and distribution. There's so much happening on the domestic economy, uh, electronics manufacturing, etc. Then I would rather be underweight on IT and put my overweights in the other segments. Even real estate, for example, I think we are just beginning to see the recovery in real estate. That can be a multi-year cycle too. So all the domestic segments are actually looking better, and when you want to put money there, obviously you are going to take money out from somewhere. And for us, as of now, it's IT.
Okay. And sorry, I'll just extend it by one more question since you mentioned real estate. You comfortable with the pure play developers, or do you reckon that the ancillaries and the suppliers are a really good way to play them too? Because different people are taking different courses.
I think take your pick. I think in building materials, while the segment is attractive, valuations at least in the large 3-4 names in each of the segments are quite expensive, I would say. So to that extent, I would stick with the large developers who are not leveraged and or in the process of deleveraging rapidly, which is where a lot of value addition can happen. In fact, if you look at the markets, places like Bombay and Pune and Hyderabad have surprised positively over the last 3-4 years as far as volume growth is concerned. So it's a pan-India phenomenon, I would say.
Great. Mihir Vora, take a moment to thank you for joining in today and giving us your thoughts. Much appreciate your time.
Always a pleasure. Thank you.
Thank you. And viewers, thanks for tuning into this edition of The Talking Point.